when you look at the entirety of the fixed income universe, it's still pretty long duration, which means that carries a lot of interest rate risk. The duration on the US fixed income ag is about 6 years. So a 1 percentage point move higher in interest rates equals a 6% loss. And traditional fixed income investors are still trying to recover from now 6 years of losses.
Hello, you're watching Proactive. I'm joined by Regan Capital CIO Skyler Weinand. Skyler, very good to speak with you again. With long-term mortgage rates higher than last September, how do you see rising or volatile rates affecting returns for investors?
Yeah, we've seen a lot of movement here just in the past few weeks, and we do have mortgage rates a little bit higher than where they were last year. But we just touched a five-handle mortgage rate in the United States. And we're starting to see some real activity, especially on the refinance side, which allows mortgage-backed investors to get paid back a lot faster. We like to focus on discounted mortgage bonds that actually benefit from prepayments. And that is not the case for most of what's being issued right now, which is fixed rate. And a lot of that's trading over par, which gets dinged and loses a little bit of money if borrowers refinance. So the jury's out on whether we might see a five-handle mortgage rate again, or whether we'll stick here in the low to mid sixes. But we're starting to see a lot more refinance and movement activity, which will benefit discounted mortgage backs.
Skyler, how's ongoing inflation shaping your approach to selecting high-quality, low-duration residential mortgage bonds for income-focused investors?
Yeah, when you look at the entirety of the fixed income universe, it's still pretty long duration, which means that carries a lot of interest rate risk. The duration on the US fixed income ag is about 6 years. So a 1 percentage point move higher in interest rates equals a 6% loss. And traditional fixed income investors are still trying to recover from now 6 years of losses. So our goal, by staying short and by staying floating rate, is to actually take advantage of potentially higher interest rates and elevated inflation. So stick to those short duration securities, ideally in floating rate instruments that can pay you for the next 5 or 6 years, and stick to government guaranteed paper where you're not really at risk from credit events and or rates and or inflation moving up and down. So we've seen that volatility already in the first few months of this year, where floating rate bonds have grossly outperformed fixed rate bonds.
Given the war in the Middle East and potential market volatility, how does the ETF's focus on government-backed securities help mitigate risk?
If we look back at historical events like COVID, Liberation Day, and now this Iran conflict, which is spreading a little bit further than Iran, the risk-off approach of U.S. Treasuries and government-backed securities have won the day relative to other credit-sensitive sectors like corporates and municipal bonds. So you're going to see very little volatility on the agency floating rate side. You're seeing a lot more volatility on the fixed rate side, and even more volatility in drawdown when you're looking at corporates, high yield, leverage loans. So this truly is a very good ballast for the rest of your traditional fixed income portfolio, which may have more credit sensitivities to them.
Just finally, Skyler, in a market with higher rates and corporate debt issuance, what advantages does your ETF offer compared with other fixed income or short duration strategies?
Right, we're going to see a lot of issuance. We've already seen a lot of corporate issuance over the last 15 to 16 months. We're talking some of these AI superscalers that for the first time in a long time are issuing a lot of debt. And so that's going to create some pressures on credit spreads. And we're starting to see the inklings of that as well on the high yield and leverage loan side, where software spreads have sold off hundreds of basis points just in the past 60 days. So gravitating towards that safe government guaranteed agency paper, which still offers upwards of about 100 basis points of spread over US Treasuries, whilst remaining short in floating rate paper is going to allow you to watch while credit bonds may become more interesting here over the course of the next year.
Skyler, it looks like an interesting year ahead anyway. Thank you very much for your insights.
Thank you.
Skyler Weinand is the Chief Investment Officer at Regan Capital.